Because remember, one Bitcoin's one Bitcoin, but we don't price Bitcoin in Bitcoin. We price
Right.
Bitcoin in dollars or euros or yen or renminbi or whatever. And so it went from 10,000 back then to 20,000 today. That's exactly what it should have done. But yeah, it's noisy in between because price got stupid in November of 2021 because a bunch of people took out leverage. Yeah, y'all, it's not inflation.
No, it's supply.
It's currency devaluation. The house I'm sitting in Chapel Hill, North Carolina, according to Zillow, went up 40% in the last 12 months. It's bullshit. My house didn't grow. It didn't get more efficient, right? I actually had to put money into it to keep it from depreciating. So that's currency devaluation. Everybody's like, oh, this is the 70s. This is nothing like the 70s. Nothing like the 70s. The 70s was demographically a period of lots of young people, 25 to 45-year-old people, 25 to 45-year-old people, perfectly nice people, a lot of them on this call, okay? Not productive members of society because they're being trained to be productive from 45 to 65. And so you borrow from your customers in the form of higher prices. That's what inflation is. Look around the world, any place where there's lots of young people, you have high inflation. When you have lots of old people, you have deflation. Japan, Europe, United States. Every single day, 10,000 people turn 65 in this country. Same thing in Europe. And that doesn't change for a decade. Working age population growth is going to zero with certainty, right? There's nothing you can do to fix it. You can't fix it. You could try to fix it with immigration, but we're going the wrong way on that, right? If it were up to me, I would send planes, literally empty planes to China and India, and I'd get all the PhDs and I'd bring them back and I'd give them free land in the middle of the United States and say, just build something. And that could solve a little bit of it, but we're not doing that. We're going the opposite way, like stay away. So this idea that somehow we're going to have this massive spike of inflation, it's temporal, right? It's oil prices. Oil prices were manipulated down by the Saudis right after the lockdowns. They sent ships over to the ship channel in Houston. They filled up all the storage, all of it, like 100% of it. And so the West Texas producers literally had no place to put their oil, which is why oil prices went negative in April of 2020. And so then they stabilized back around $40. Then they went to 120. Okay. That's what we're seeing in the CPI. But that's this. It's the printing of money. And that's why everybody's like, oh, well, Bitcoin's not a good inflation hedge. Are you joking? In a 9-month period following the lockdowns, the Fed printed half of all the dollars that have ever existed in the history of our republic. 246 years, one half were printed in 9 months. So what should have happened to the price of Bitcoin? It should have doubled. Because remember, one Bitcoin's one Bitcoin, but we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars or euros or yen or renminbi or whatever. And so it went from 10,000 back then to 20,000 today. That's exactly what it should have done. But yeah, it's noisy in between because price got stupid in November of 2021 because a bunch of people took out leverage. I throw my brother under the bus all the time because they stole my Bitcoin. What are you talking about? It's like, well, I went to BitMax. Like, stop. You levered an 80 vol asset and the price went down and you didn't make the margin call and they seized your collateral. You're a fucking idiot. Okay.
I was talking before the show about how I took a 10x leverage position. If he's an idiot, can you imagine what I am?
He had higher than 10x. You don't lever 80 vol assets. Look, I don't think it's happening. You have to go back a long way to find dumber policy decisions than what the Fed is doing right now. Okay, there's only twice in 200 years where have been worse policy decisions. The worst ever was 180 years ago in 1840. And we had no Fed, right? We're in the free banking era. There was no national bank. And we had a garden variety recession and banks were all freaking out because they had all issued their own money, right? Texas issued their own money. Companies issued their own money, literally had all kinds of script running around the United States. And long story short, they raised rates and caused the depression, right? First depression since the country started in 1700s. And 90 years later, you had the second worst policy decision in history, two-part. One, the dumbest people in Congress, which is kind of like an oxymoron, but okay, Smoot and Hawley, dumbest people ever in the history of American Congress, decided to pass legislation to put up tariffs into the crash, right? Deglobalization. Globalization is good. Adam Smith was right 450 odd years ago, okay? Deglobalization is bad, populism is bad, nationalism is bad. All isms, other than capitalism, are bad. Isms are not good. Ferris Bueller was right. And so that was the first problem. Then the second problem was the Fed back then, which had just been created, the creature from Jekyll Island in 1913, raised rates and turned a garden variety recession into the Great Depression. The worst year in the stock market was not 1929, it was 1931. We are on pace to have the worst year in history now, other than 1931, and probably exceed 1931. The 60-40, to Ralph's point, is the worst in all of market history. 140 years, never been a worse 60-40. So everything's, in fact, I put out a tweet Friday, said breaking, everything. And then literally on Sunday, what do? The UK says, keep calm, we'll print more. And they saved the pension system in Britain. The pension system in Britain was bankrupt. Let that word sink in for a second. Leverage can never make a bad investment good. Never.
Okay.
It can, and often does, make a good investment bad. Buying long bonds is not a bad thing. Buying long bonds on leverage into a rising rate scenario is suicide. But the investment bankers, here, we'll give you these derivatives for free. Anything that's free is very costly because they're taking 4% off the top and they're giving it to you at precisely the wrong time. Because guess what? It's easier to sell stuff to people when it's hot, right? It's not easy to sell straw hats in the winter, right? So you got to sell them in the summer. And so when everything's going great, they want to sell you leverage because they're like, interest rates are low. I got this LDI, liability driven investing. I need to match my assets and liabilities. So I'll lever up. Look, they sold a bill of goods by Ray Dalio and risk parity. One of the dumbest long-term, look, short-term it works in a falling rate environment. It's awesome. Lever up, great. And Ray Dalio is a multi-billionaire and I'm not, so I'm not criticizing him, but actually I am. But the idea of risk parity in a pension fund and using leverage, they should not shoot. Anyway,